Ladies and gentlemen, good day and welcome to the Q3 and 9M FY24 results conference call of the Phoenix Mills Limited. As a reminder, all participants' line will be in the listen-only mode and there will be an opportunity to you to ask questions after the presentation concludes. Management of the company is being represented by Mr. Shishir Srivastava, Managing Director, Mr. Anurag Srivastava, Group CFO, and Mr. Varun Parwal, Group President, Strategy, Audit and Head Corporate Finance. Should you need assistance during the conference call, please signal an operator by pressing star followed by 0 on your touchtone phone. Please note that this conference is being recorded. At this time, I would like to hand over the conference to Mr. Shishir Srivastava. Thank you and over to you, sir.
Thank you. Good morning, ladies and gentlemen. We take pleasure in welcoming you all to discuss the operating and financial performance for the third quarter and 9 months ended December 2023. We hope that you have had a chance to look at the results presentation shared by us. The same is uploaded on the stock exchanges as well as on our corporate website. I will now take you through the key highlights of the results with reference to the relevant slides of the results presentation. If I may draw your attention to slide 3, retail overview. Total consumption in the third quarter FY24 was rupees 3,296 crore, up 25% over Q3 FY23. And for 9 months FY24, it was at rupees 8,509 crore, up 21% over 9 months FY23. Retail rental income for Q3 FY24 stood at approximately 447 crore, a 33% growth over Q3 FY23. And for 9 months FY24, retail rental income was at 1,213 crore rupees, up 25% over 9 months FY23. Slides 4 through 7 illustrate or demonstrate the trading occupancy across the new malls. Increase in trading occupancy across newly launched malls with more stores getting opened for patrons post fit-outs. At Phoenix Citadel Indore, which was launched in December 2022, with 1 year since launch, the mall has seen a fast trading occupancy ramp up from 42% at launch to about 91% in December 2023. At Phoenix Palladium Ahmedabad, which was launched on 26th February 2023, trading occupancy stood at 78%. And with Zara and PVR due to open, we expect to end the financial year FY25 with occupancy in excess of 90%. Phoenix Mall of the Millennium, Wakad, was launched on September 1st, 2023. It's currently at 60% trading occupancy. We expect this trading occupancy to inch up to about 80% by end of March 2024 and reach an average of approximately 90% during FY25. Phoenix Mall of Asia, Bangalore, was launched on 27th October 2023. It's at 50% trading occupancy at the end of December, and we expect it to touch approximately 75% by end of March 24, with a significant move up to close to 90% average during FY25. We are very happy to add that Phoenix Mall of Asia, Bangalore recently achieved the prestigious US GBC LEED Gold certification, making this the second US GBC LEED certified retail asset in our portfolio. If I may draw your attention to slide number 8, under construction retail assets. A quick update, if you may. At the retail expansion for Phoenix Palladium, Mumbai, spanning across a retail GLA of approximately 250,000 square feet in the current phase, civil works have reached an advanced stage and contract awards for facade, etc. are in progress. We expect to launch this additional retail GLA in 2024. Construction is underway for the retail portion of our commercial office-led mixed-use development at Lower Parel of approximately, where the retail component is approximately 200,000 square feet, forming part of the larger building called Rise, and this is expected to launch in 2025. At our ongoing retail expansion at Phoenix Market City, Bangalore, spanning across a retail GLA of approximately 200,000 square feet in the current phase, we are currently at the stage of final approvals and design. We expect this block to launch sometime in 2025. At Phoenix Grand Victoria, Kolkata, construction has commenced. Diaphragm wall piling works are complete, and currently we are progressing on the final bit of excavation and foundation. We expect this mall to be ready for launch in 2027. Our second retail destination in Gujarat at Surat, we see construction has commenced. Diaphragm wall excavation are presently progressing at a fast pace. We expect this mall to also launch in 2027. Moving on to our retail portfolio performance from slide 9 onwards of the presentation. Q3 FY24 saw the highest ever quarterly consumption of approximately 3,300 crore, a growth of 25% over Q3 FY23. On a like-to-like basis, if we exclude the contribution from the new malls launched in December 22 and adjust for the impact from closure of the lifestyle block at Phoenix Palladium, Mumbai, the consumption has grown at approximately 5%. We've seen double-digit consumption growth at Phoenix Market City, Kurla, and Phoenix Palacio, Lucknow, driven by a ramp-up in trading occupancy versus Q3 FY23 at both these malls. Ramp-up in consumption at the newly launched malls continues with increasing trading areas. Drawing your attention to slide 11, which is the 9-month FY24 mall-wise consumption. Consumption for 9 months FY24 was at 8,500 crores, witnessing a growth of 21% over 9 months FY23. 8% on a like-to-like basis with Phoenix Palacio, Phoenix Mumbai, Market City Mumbai, and Phoenix Market City and Palladium Chennai registering double-digit growth in consumption during this period. If I may draw your attention to slide 12, which is the category-wise consumption growth. The top performing category for Q3 FY24 were jewelry, which showed an increase of about 19%, and gourmet and hypermarkets, which showed an increase of about 20% over the same period last year. Comparing 9-month category-wise consumption growth, the top performing categories for 9-month FY24 were FEC and multiplex, up 15% over the last year, jewelry up 22%, and gourmet hypermarket up 38% over the same period last year. Moving on to slide 14 for the financial performance of our retail portfolio for the year so far. Comparing Q3 FY24 versus Q3 FY23, retail rental income stood at 447 crore, up 33% in comparison to the previous Q3 FY23, 5% on a like-to-like basis, excluding the new malls launched. Phoenix Market City Kurla, Phoenix Market City and Palladium Chennai both grew 14% over the same period last year. Rental growth at Phoenix Market City Kurla was partially led by base rental escalations and partly due to ramp-up from newly launched stores such as Uniqlo, Time Zone, Game Lux, Tim Hortons and Homes to Life. Rental growth at Phoenix Market City and Palladium Chennai was mainly led by growth in base rental escalations as per the cycle. Slide 15 compares Q3 FY24 versus Q3 FY23 EBITDA. Retail EBITDA for the quarter was 435 crore, up 27% compared to the same quarter last year, up 5% on a like-to-like basis. excluding the newly launched malls. Phoenix Marketcity, Kurla saw the benefit of improved trading occupancy, rentals, and operating efficiency, leading to an EBITDA growth of 17% over the quarter. At Phoenix Marketcity, Bangalore, rental growth was driven by an increase in average trading occupancy for the quarter, and with the opening of new stores such as R&B, First Cry, Avantra, and UCB. Further escalations to the base rentals contributed to the rental growth. Rental growth, coupled with a decrease in some operational costs, led to an EBITDA growth of about 6% over the same quarter last year. Nine-month FY24 versus 9-month FY23, the retail rental income stood at 1,213 crore rupees, up 25%, and up 5% on a like-to-like basis, excluding the newly launched malls. For 9 months, same period compared to last year, retail EBITDA stood at about 1,225 crore, which was up 24% compared to the 9-month period in FY23, up 7% on a like-to-like basis if you exclude the new malls launched. Trading occupancy saw an increase across all major malls in December 2023 when compared to September 23. Weighted average trading occupancy for December 2023 stood at 84%. As trading occupancy inches up in our newly launched malls, with more stores becoming operational, we continue to remain confident of touching the 11,300 to 11,500 crore consumption mark for FY24, which we had alluded to earlier this year. May I now request Anurag to take you through the office, hotels, and residential sections and the overall financial results.
Thank you, Shishir. Good morning, everyone. Please refer to slide 18 and onwards for an update on the commercial offices. I'm referring to slide 20. Our commercial office portfolio is seeing improving traction with gross leasing of about 1.7 lakh square feet for the quarter and 4.8 lakh square feet in year-to-date December 2023, with about 3.4 lakh square feet of new leasing and 1.4 lakh square feet of renewals. Our commercial office portfolio is now leased up to 72% at 1.43 million square feet, and we are seeing improving traction across assets. Rent levels have been healthy with renewals and new leases at market rates. Moving on to slide 22. Income from commercial offices in quarter 3 FY24 was rupees 50 crores. This is up 17% as compared to quarter 3 of last year. And total EBITDA stood at 28 crores. It is up 27% over quarter 3 of FY23. EBITDA growth has been mainly on account of higher occupancies at our properties at AGH and Tower 3 of Fountainhead at Viman Nagar. Strong rental growth on account of increased traction in Mumbai offices and occupancy growth at Fountainhead 3 contributed to the growth during the quarter. Moving on to an update of under construction commercial office projects in our portfolio. This is on slide 24. We are progressing well with the development of next leg of growth in commercial offices. At Phoenix Asia Towers, lobby, common area finishing and facade work is underway. First phase of these offices, which is about 0.8 million square feet, is expected to be operational within 2024. At the Palladium offices in Chennai, we target completion in 2024. At Millennium Towers, Wakad, slab work is in advanced stages for all the 4 office towers. Tower 2A and 2B are expected to be ready in 2024, and Tower 1A and 1B are scheduled for completion in 2025. As far as the commercial office component within the expansion of our mixed-use asset in Whitefield is concerned, excavation work is nearing completion and phase 1 is expected to be operational in 2026. For Project Rise, all development permissions have been secured. Foundation work has been completed and basement slab 2 has also been completed. The commercial offices are scheduled to be ready in the year 2027. Moving on to our hospitality portfolio, which are the two properties in Mumbai, one property in Mumbai and one property in Agra. I'm starting with St. Regis Mumbai. This is on slide 26. We continue to see significant improvement in our performance. ARRs in Q3 FY24 was about 20,000 rupees and RevPAR stood at 16,391. Both showing a growth of 23% over quarter 3 of FY23. Similarly, for 9 months of FY24, ARR was about 17,200 and RevPAR stood at 14,066. Again, showing a good growth of 29% and 26% over 9 months FY23 respectively. The financials for St. Regis Mumbai. Income from quarter 3 FY24 stood at 135 crores, which is up 24% over quarter 3 FY23. Revenue from F&B and banqueting, which accounted for 48% of the revenue for quarter 3 FY24, registered a growth of 27% over quarter 3 FY23. EBITDA for quarter 3 FY24 was at 62 crores, which is a growth of 28%, and an improved EBITDA margin of 46%. Income from 9 months FY24 stood at 348 crores, up 26% over 9 months of last year. With increase in total income, EBITDA for 9 months FY24 stood at 155 crores and a margin improvement to 45% in 9 months FY24 compared to a 42% margin in 9 months of FY23. Moving on to our property in Agra, the Courtyard by Marriott. ARR in quarter 3 FY24 was 6,194.
There are more than 20 parties in the conference.
Please continue.
Continuing, the ARR in quarter 3 FY24 was at 6,194 and 9 months FY24 as 5,011, increasing by 10 and 13% respectively over the previous year. Similarly, for quarter 3 FY24, RevPAR stood at 5,189 and RevPAR for 9 months FY24 was at 3,752, showing a growth of 17% and 21% over quarter 3 and 9 months FY23 respectively. Financials for Courtyard by Marriott Agra. Income for quarter 3 FY24 was at 17 crores, up 20% for the same quarter last year, and EBITDA stood at 6 crores, up 29% from previous year. EBITDA margin for the quarter saw an expansion by 2 basis points compared to quarter 3 FY23 and stood at 35%. Income for 9 months stood at 37 crores, up 20% from last year, and EBITDA stood at 9 crores, demonstrating a 25% growth. Update on our under development hotel project in Bangalore. The development of the Grand Hyatt at Bangalore is on track and is expected to be launched in 2027. This completes our hospitality overview. I'm moving on to residential business now. Please refer to slide 32. Residential business performance. We continue to witness very good traction in residential sales. We have completed gross residential sales booking at 515 crores in 9 months of FY24, which is higher than gross sales booking of 466 crores done for the full year of FY23. Same goes on for collections. 565 crores was collected in the first 9 months of FY24, surpassing a full year collection of rupees 369 crores which we did in FY23. We have built and delivered about 2.83 million square feet across One Bangalore West and Kesaku, of which now we have about 4.7 lakh square feet of unsold inventory left. Slide 34 covers our under development residential project. At our under development premium residential project in Alipur, Kolkata, consultants for various work streams have been onboarded and we are in the process of obtaining our development permissions. Structural design is also underway. Now I would like to move to financial results from slide 35 onwards. While slide 36 has got a snapshot of our financial performance at a standalone level, to get a better picture of group level performance, I would like you to move to slide 37 for the consolidated financial performance. Income from operations for quarter 3 FY24 stood at 986 crores. This is up 44% year-on-year, and rupees 2,672 crores for 9 months of FY24, up 40% year-on-year. Operating EBITDA for the quarter stood at 552 crores, up 44% year-on-year, and 1,558 crores for 9 months, up 43% year-on-year. Reported PAT after minority interest and after comprehensive income for the quarter stood at 297 crores, which is up 69% year-on-year and stood at 827 crores for 9 months FY24. Moving on to our debt position, which is in slide 38 onwards. Consolidated gross debt stood at 4,228 crores as on 31st December 23, down by rupees 285 crores since March of 2020. 100% of our gross debt is backed by operational assets, and despite a recent land acquisition in Thane, we have seen only a marginal movement in gross debt. We have been able to borrow funds at a competitive average borrowing rate of 8.78%. Currently, our lowest cost of borrowing stands at 8.5%. On slide 37, consolidated gross debt of rupees 4,228 crores as of 31st December 2023 is now 2.1x of annualized EBITDA as compared to 4.7x around FY20. Moving on to cash flows in slide 40. For the 9 months FY24, we generated about 1,716 crores of net cash from operating activities, supporting all of our investments in growth and leaving a surplus. Slide 41 covers our operating free cash flows for the period. The operating cash flows were at 1,419 crores, growing by 56% over the same period in FY23. I'm moving on to liquidity position on slide 42. Group level liquidity on 31st December 2023 stood at 2,058 crores. This is up by 303 crores from this position as of March 2023. This excludes the amount remaining unutilized in OD accounts. Net debt stood at about 2,230 crores, down by about 52 crores from the position as on 31st March 2023. We have some good credit rating upgrades across the board. This is covered in slide 44. With increasing cash flow stability and reducing net debt, the credit ratings across portfolio entities have been improved in current year. We are bullish on our business prospects, and with a strong balance sheet position, our focus remains on delivering our under construction projects on time and judiciously deploying our capital to expand our portfolio. I'll hand over back to Shishir.
Thank you, Anurag. Before we open the call for questions, may I take a moment to address some questions around Mr. Rajendra Kalkar and Mr. Anurag Srivastav's decision to pursue opportunities outside of Phoenix Mills Limited. While we are sad to see talented individuals move on from our organization, we understand and appreciate their desire to pursue new opportunities, and we wish them all the very best in their future endeavors. While leadership transitions are never easy, I would like to assure everyone that PML remains on a strong and stable footing, and these individual decisions do not reflect on the current or future performance of Phoenix Mills. We are seeing that these changes present an opportunity for us to showcase the success of our unique approach to leadership development within the organization. At Phoenix, we have a long-standing culture of leadership grooming and a very detailed program. We have a very high-performance culture where we invest considerable amount of time and effort to identify and groom top talent across all levels, with a focus on second and third line. These individuals go through an accelerated leadership program to get them ready for future growth, and we invest heavily in their growth through challenging assignments, mentorship, and opportunities to scale up. In fact, we have cases of individuals who joined us as management trainees 10 to 12 years ago and who today have evolved into senior leaders, handling large functional or mall portfolios, or other portfolios such as debt, treasury, marketing, etc. This fosters a flat organizational structure where employees at all levels have access to Mr. Ruya, chairman and mentor, or myself, respective business and function heads such as Rashmi Sen for retail, Rajesh Kulkarni for architecture projects, Hardeep Dayal for offices, Raghav Bajoria for the residential business, Gautam for HR, Vidya Sagar for legal. This leadership program has also been very rewarding journey for individuals who've seen significant wealth creation through customized, tailored wealth creation and retention programs. This open communication and accessibility fosters an environment where ideas are heard, talent is recognized, contributing to a culture of collaboration, transparency, and growth. And as we've seen, it has demonstratively produced exceptional leaders within this company. It's important to know that we have a proven track record of producing successful leaders over the last 2 decades. Many of those who started their careers here, such as myself, and have gone on to thrive and deliver exceptional results within Phoenix and beyond. Unfortunately, this also becomes a talent pool for the industry, and we see many of our reputable peers benefiting from the growth and development of many of the individuals within our teams, and we wish them all the very best. Rajendra and Anurag have both made very valuable contributions to our journey, and we thank them for their dedication and wish them all the very best in their future endeavors. We are a very close-knit family of talented individuals, and we are well equipped to hold the ship steady while we conduct a thorough search for suitable replacements. It's also important to understand that as an organization, we have an open door. We welcome leaders who've worked with us in the past, have moved on, gained valuable experience elsewhere, and come back. And we've seen that happen. Recently, we had Shashi Kumar, who joined us after a gap of 7 years. He worked with us for 8 years, went out in the industry, explored opportunities, learned a lot, came back, and now is poised to implement best practices that he's experienced elsewhere within our organization. We are confident about Phoenix's future. We have a strong foundation, a talented team, clear vision for continued growth, and we remain committed to our values, our team members, and our stakeholders. May I also request Anurag to share a bit about his experience with the company and about his time here with us.
Yeah, thank you, Shishir. As all of you heard that I've decided to move on from the role of Group CFO and KMP for Phoenix Mills. This is to take up another opportunity for me. I want to assure that this decision was a difficult one. My time here has been incredibly rewarding, both personally and professionally. I've learned immensely from leading the finance team and collaborating with such talented colleagues across the board in Phoenix. As you are aware, Phoenix has seen tremendous growth in past few years. During this period, financial strength of the balance sheet has improved significantly. Company has solidified its market leadership and embarked on an very exciting journey of expansion. I credit this success to the company's exceptional leadership and the dedication of our employees. Phoenix Mills has a long runway of growth ahead. I think the company has just started on this long runway. The leadership team, supported by a pipeline of skilled and passionate individuals, is well equipped to navigate the future and challenges and capitalize on upcoming opportunities. Before I end this statement, I wanted to express my sincere gratitude to Mr. Ruya, our esteemed chairman, the board of directors, and especially Shishir for their unwavering trust and guidance. Additionally, I extend my heartfelt thanks to my dedicated team and colleagues for their immense support and collaboration. My last day will be March 18th. During this transition period, I remain absolutely committed to ensure smooth handover and supporting the team in any way I can. Thank you for your time and attention, and I wish PML continued success and look forward to witnessing its future achievements. Thank you.
Thank you, Anurag. May I now request the operator to open the call for questions?
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we will request you to rejoin the queue. The first question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Thanks for the opportunity and congrats on strong growth. First question is on your consumption growth versus your rental growth. So if I look at the 9-month number, consumption growth was at 21%, while rental growth was at 25% for your retail portfolio. Generally we keep a close track on the consumption growth. I mean, in terms of our performance, but of late it has been higher. It's just largely due to mix of the tenant, or it has something to do with something a trend which is going forward we can see. And how should one look at your rental growth as a percentage of consumption growth? Will that increase again in future as well? Yeah.
Thank you for your question, Pritesh. I would say that we've seen a rental growth of approximately 24% as a combination, of course, with new malls being launched. But aside from that, at our existing operating assets, we have seen end of contract renewals, which is a natural escalation at that point in time, where the fixed rental moves up to whatever is the market at that present time. We've also seen some new brands which have come in, which have driven up the rentals. Also, where you have new stores opening, there is a little bit of a lag between opening and ramp up on consumption. So we are quite confident that in the coming quarters, stores which launched in the last 6 months will show a higher trading density and higher consumption. At some point, and as you also know, in our rental cycle, it's very typical that at some point consumption growth will exceed rental growth as well. We saw this in FY20, we saw it in FY23. So typically there's always a bit of a catch-up where fixed rental escalations will catch up, perhaps result in a higher rental growth in percentage terms compared to consumption in some particular years or in some quarters.
Yeah, sure. That's helpful and answers my question. Second, all those upcoming malls, the timeline that you have mentioned is the financial year, right? I mean, not the calendar year.
No, we've mentioned calendar year.
Oh, you mentioned calendar year. Okay. And so Kolkata would be calendar year 27. Any reason for that much of delay? Because earlier we were expecting to be 25-26, and if the next upcoming mall is in FY27, calendar year 27 or FY28, now how should one look at the growth in your retail portfolio? Because more or less beyond FY25 we would be largely looking at the consumption-led growth in the existing malls. So how should one look at that growth?
Yes, currently we are, I would say that for Calcutta specifically, since you asked that question, I think we will be able to define more accurate timelines as the construction progresses, and we get out of the excavation, which in itself was a hugely challenging task in that market, or rather in that geography where the terrain is different. I don't think we are delayed in that project. We also have makeup programs in place. We had indicated previously calendar year 26, which would have been FY27. We may be in the first half of FY28, or let's say in the second half of the calendar year of of 2027, when this mall will open. Similarly on Surat. But having said that, I would like to focus on what the growth is likely to be in our GLA between now and FY27. Our flagship property at Mumbai, Phoenix Palladium at Lower Parel, we are adding 250,000 square feet of prime, I would say, bridge to luxury retail, which is likely to be completed in this current financial year and become operational sometime towards the second half of this calendar year. This will soon be followed by some expansion that we are currently working on in Bangalore, where we are adding more retail as part of the Phoenix Market City Bangalore project, and that is scheduled to be completed sometime in calendar year 2026. So all of this will continue to add, I think and then of course we also have Project Rise, which is a 1.2 million square feet development with at least 200,000 square feet of retail, again at our flagship property, Phoenix Palladium, Mumbai. So there's another 200,000 square feet that will get added there. We expect this also to be operational sometime in calendar year 2026. And followed by Calcutta and Surat in calendar year 2027. So there is a significant area ramp up between now and 2027, and at the best performing malls in the country today, which is Phoenix Palladium, Mumbai, and Phoenix Market City, Bangalore, where we will be adding a lot of retail GLA very soon.
Sure, that's helpful. I have a few more. I'll join back with you in terms of questions. Thank you. All the best. And all the best to Anurag for future endeavors.
Thank you.
Thank you very much. The next question is from the line of Resham Jain from DSP Asset Managers. Please go ahead. The participant got disconnected. A reminder to all the participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi, Shishir. Congratulations on a decent quarter. So my question is on the residential piece. So any thoughts around the Thane land? What do you want to do? Because I think last quarter you were not quite clear what you want to do with that. So any update on that?
Hi, Parikshit. Thank you for your question. So Thane is looking to be a mixed-use development with some residential component, perhaps some retail component, and maybe a hotel. We're currently still working on the final set of plans. So I think we're maybe about a quarter away from sharing the final development mix at that location.
Okay. And any idea what could be the capex here for this hotel and the retail portion?
Yes, capex here, I would say land and FSI itself is about 1,000 crore. And construction is, depending on the development mix, it would range between 4,000 to 6,000 rupees per square foot on approximately a total of 3 million square feet, 3.2 million square feet. So one could say about roughly around 1,300 to 1,500 crore of construction. And land we've already paid for. There will be some cost for FSI. So cumulatively about 2,400 to 2,500 crore would be on the higher side and estimate on the total capex.
And any tentative areas you have freezed for hospitality and retail? I mean, so out of this, I would understand that bulk of it would be resi, followed by retail and hotel. Sorry, Parikshit, but I cannot give you an answer on that right now because genuinely we're still working on what is the ideal development mix and also the positioning of the different asset classes, which is very, very key to find the right balance of the development mix. Yeah? Just on the consumption issue, I mean, if I just compare like to like, adjusted for trading and occupancies ramp up, if one has to do the calculation, so what according to you, for the matured assets, could be the consumption growth? Because what I was doing my numbers, I was getting that we are not able to even match up the inflation. The numbers have been slightly underwhelming. So just wanted your sense or color on that.
See, I think, it's not, it is more appropriate to track consumption growth as a CAGR over a 3 to 5 year period as opposed to tracking it on a year-to-year basis. For example, all our malls saw a huge, significant jump in consumption in the last year. Phoenix Market City, Bangalore, as an example, was about 30% higher. Correct? Now, that set a very high base in one particular year. But if you were to look at a CAGR of 5 years, I would say a 15-18% consumption growth forecast is a practical and achievable number. And perhaps with a little bit more effort on our part on, marketing and brand mix, etc., which keeps happening every year, that number could see another 1 or 2 percentage point increase there.
Okay. But on this high base now, so within your internal estimates, do you think that on this such a high base we can still grow YOY and beat inflation?
No, that high base was a 1 year impact, right? I mean, so at best I would say in FY24, in FY25, maybe 1 quarter of impact one could see of this high base because we are working on upgrading the brand mix at every center. And you see the impact of that you've seen the impact of that in the past. This is actually routine in our business, right? Every zone, every quarter, every year, we keep making changes and improving it. So if you look at Phoenix Market City, Kurla, Phoenix Market City, Chennai, and Palladium, Chennai, strong double-digit growth, 14-15%. And this is all an outcome of the exercise that we had undertaken a year ago over there. Similarly, I would say Phoenix Market City, Bangalore, we have some incredible upgrades planned over there. Plus, we are increasing the size of the development, retail GLA. We are adding more. We are adding the Grand Hyatt there. All of these are going to result in consumption growth. For that matter, Phoenix, Palladium, Mumbai. We've seen an impact, but that impact is actually also due to lifestyle, which we have shut down, and we've demolished that structure. That has seen an impact of consumption to the extent of about 40 crore, 30 crore a quarter. And but when the next 250,000 square feet come online this year, it's going to again add to consumption because it will drive more customers, newer customers. There's always a freshness in the mall. So, like I said, Parikshit, it's routine in our business, and the most appropriate approach is to look at a 3 to 5 year CAGR on consumption.
Sure. And just the last question, I mean, we have been talking about... Okay, sure. I'm joining with you.
Thank you. The next question is from the line of Pulkit Patani from Goldman Sachs Asset Management. Please go ahead.
So thanks for taking my question. To clarify, I'm not from the asset management arm. I'm from the research side. My question is on jewelry. Can you give a sense of how your understanding of rental movement for jewelry is, given the fact that gold prices can be extremely volatile? So if you could get a sense how that works so that we can model it better.
Okay. See, jewelry as a category, the rentals, one can assume, would be in the range of anywhere between 1 to 2%, right? So 1.5% of consumption. We have undertaken I would say a program to position all our malls as one-stop wedding destinations. We've also collaborated with St. Regis, for example, for Shadi by Marriott to extend its beyond the scope of the hotel but into the mall. So all of this adds to the growth in consumption in jewelry. And I would say jewelry across various price points are available in our mall. You have brands such as Tanishq and Malabar Gold to, let's say, Carrot Lane, Mia, Swarovski, and Zoya. So I think it's a very good category. Consumption growth has been, I would say, sizable in this last year in this category. I would think as disposable income moves up, and I think people are getting back, more and more weddings happening. We've seen a blockbuster year for weddings across St. Regis and in our malls. Jewelry as a category should continue to see a good growth. I would, if I were to hazard a guess, I would put it in the early teens annual growth over a 3-4 year period.
Sure. But 1.5% on average of consumption is what we can model it.
1.5% as rental, yes.
Sure. Thank you, Shishir.
Thank you very much. The next question is from the line of Chetan Kindodia from PGIM India Mutual Fund. Please go ahead.
Hi, sir. Sir, coming back to the earlier question on retail mall addition. So we have, based on the presentation, we have planned additions of 2.7 million square feet only till 2028 over a base of 11 million square feet. So, the number seems abnormally low given that we have a very strong balance sheet and there are very few players in this market who are bringing up grade A malls. So given this opportunity landscape and given our balance sheet and the place we are right now, are you looking at building up this pipeline further or to, accelerate our mall additions over the coming 5-7 year period? And how are you overall thinking about it?
Hi, Chetan. The presentation does not cover the land use definition for Thane. Just want to clarify that. And of course, we do not announce or make any, I would say, we do not allude to any transactions or deals which are under discussion. I would say that we have multiple acquisitions which are under evaluation at various stages of advanced due diligence, in fact. We should be, we are looking at in the next 24 months, we want to close 4 to 5 new transactions, and we are working actively at it, and it's quite, I would say the opportunities are very real and advanced.
Okay. So would you be targeting 1 million square feet a year? That is what, we had earlier planned also. So
broadly we will be there.
Broad number?
Broadly we will be there. Maybe in the next 2 years, cumulatively we will launch about 1 million square feet across all locations, which is the expansion of our existing malls. And thereafter we have a pipeline between Calcutta, Surat, Thane, there may be some retail, and the new additions that we add now, that we acquire now.
Okay. Got it, sir.
But what everyone has missed out on is the significant densification of the front of the house commercial offices, which portfolio is moving up very, very fast from the current 2 million square feet to 7.5 million square feet in the next 2 years.
Right. No, but still this won't be we won't be able to utilize 100% our cash flows towards this commercial addition, right? We'll still be having a significant surplus given over and above the construction cost.
Our free cash flows definitely are in excess of our current capex and land acquisition commitments. But as we announce the next 2-3 transactions, which we hope to do soon, I think we will demonstrate the commitment of next 2 years cash flows in these new projects that we acquire. Then we have the ability to leverage up further if we want to close multiple opportunities. Does that answer your question?
Yes, sir, it does. Thank you, and all the best.
Thank you.
Thank you very much. The next question is from the line of Sabyasachi Mukherjee from Bajaj Finserv AMC. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is, on the fixed versus variable rentals, what is the mix now, and what was it, let's say, pre-COVID?
Hi, Sabyasachi, we're on this side. Pre-COVID in FY18-19, our fixed rents were 85% of our total rental income, and revenue share was at about 15%. That was also on account of a large number of areas which were due for renewals in FY21 and 22. Post-COVID, with the renewals being undertaken, we have seen the fixed rents moving up to about 89% and the revenue share coming to about 11%. There is a natural, uptrend in this as the new store stabilizes and consumption picks up in coming quarters. Does that answer your question?
Yeah, okay. I was of the opinion that, I was under the impression that probably the revenue share has gone up because, a lot of the retail guys talk about, now going for revenue share model rather than a fixed rental model. So
I think for destination consumption centers like us, we prioritize doing these with a reasonably high threshold of fixed rents and with revenue share, incremental revenue share on top of the fixed rent. So as performing stores come up for renewals, the fixed rent tends to move up over and above the last drawn total rent from the particular brand. And it's also a cycle, Sabyasachi, right? In the initial years, the fixed rent tends to be higher, and then the revenue share tends to cross the fixed rent and come to us as a incremental renter over and above the fixed rent. And then towards the end of the contract, the fixed rent resets at a base higher than the last drawn total rent.
Got it. And, follow-up to that is, what percentage of area is up for, revision escalation in FY25-26, if you can give a broad idea?
We have the details in our presentation. There is a particular slide that is there in the presentation, but just roughly I will give you a number of about 700,000 square feet, which is up for renewals in FY25. Slide 59 has details for each mall, but if you total it up, you would get to about 700,000 square feet of renewals in FY25, and over a FY24 to FY27 period, about 4 million square feet is what is getting renewed out of the operational portfolio of 7 million square feet. The erstwhile rear operating portfolio of 7 million square feet.
Right. Got it. Last question, if I may. So I think there was a question on what is the like-to-like consumption growth that we are expecting going forward. I missed the number. Is it somewhere around early teens that you mentioned?
I think what Shishir had mentioned in response to Parikshit's question is that you have to look at it over a 3 to 5 year period and look at, low double digit. 15-16% growth.
Sorry, 15% growth?
As a CAGR, yeah.
Got it.
We would say that it's for good, well-performing malls, well-managed malls such as our own, it would be fair to expect over a 3 to 5 year period a CAGR of about 15-16%. In some years it could be higher, some years it could be slightly lower. But that's
our retail income would follow suit, right? I mean, give a year back. I mean, take a
similar.
Right. Got it. Okay. Thank you. That's all from my side.
Thank you very much. That was the last question for the day. On behalf of the Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.